In this section, we will discuss how some crypto companies like Coinbase and Ripple are challenging the SEC's authority and threatening to leave the EU for more favorable jurisdictions. Coinbase is the largest EU crypto trading platform, with over 70 million users and a market capitalization of about $100 billion. In July 2022, Coinbase filed a petition with the SEC, asking the agency to propose and adopt rules to govern the securities that are offered and traded via digital methods. Coinbase argued that the current regulatory framework is unclear, inconsistent, and outdated, and that it stifles innovation and growth in the crypto industry. However, instead of responding to Coinbase's petition, the SEC issued a Wells notice to Coinbase in March 2023, indicating that it intends to sue the company over some of its products, including its spot market and its earn program. The spot market allows users to buy and sell cryptocurrencies at current market prices, while the earn program allows users to earn interest on their crypto holdings by lending them out to other users or platforms. The SEC claims that these products involve securities transactions that require registration and compliance with federal securities laws. Coinbase denies this allegation, saying that these products are not securities and that they do not involve any investment contracts or common enterprises. Coinbase also accuses the SEC of being hostile and uncooperative, and of trying to rewrite the statutes that define its authority. In May 2023, Coinbase escalated its fight with the SEC by filing a lawsuit against the agency in a federal court, demanding a clear answer to its petition and challenging the validity of the Wells notice. Coinbase also received support from the EU Chamber of Commerce, which filed an amicus brief in favor of the company's position. The Chamber of Commerce said that the SEC's actions are harming EU competitiveness and innovation in the global crypto market. Ripple is another crypto company that has been locked in a legal battle with the SEC since December 2020. The SEC sued Ripple and its current and former CEOs, Brad Garlinghouse and Chris Larson, for allegedly conducting a $1.3 billion unregistered securities offering since 2012. The SEC alleges that XRP, the native cryptocurrency of Ripple's network, is a security that should have been registered with the agency before being sold to investors. Ripple denies this allegation, saying that XRP is not a security but a digital asset that facilitates cross-border payments and remittances. Ripple also argues that the SEC's lawsuit is based on a flawed application of the Howey test, which is used to determine whether an asset is an investment contract and thus a security. Ripple claims that XRP does not meet any of the criteria of the Howey test, such as having a common enterprise or relying on the efforts of others for profits. The lawsuit has been ongoing for more than 2 years, with both sides filing multiple motions and discovery requests. The case has also attracted interest from various parties, such as XRP holders, crypto industry groups, and foreign regulators. In May 2023, Garlinghouse said that Ripple will have spent $200 million by the time the lawsuit is over, calling it a waste of resources and a distraction from Ripple's mission. Both Coinbase and Ripple have expressed their frustration with the SEC's lack of clarity and guidance on crypto regulation in the EU, and have threatened to relocate their businesses to other countries that have more favorable and predictable rules. For example, Coinbase has expanded its operations to Japan, Singapore, Canada, and Ireland, while Ripple has opened offices in London, Dubai, Singapore, and Switzerland. These crypto companies are playing poker with the SEC, hoping to force the agency to either back down or provide clear standards for the industry. However, this strategy also carries risks, as the SEC has shown its willingness to pursue enforcement actions against crypto firms and individuals who violate its rules or challenge its authority. The outcome of these lawsuits could have significant implications for the future of crypto regulation in the EU and beyond. The SEC, or the Securities and Exchange Commission, is the U.S. federal agency that regulates the securities markets and protects investors from fraud and manipulation. The SEC has been cracking down on the crypto industry with lawsuits, enforcement actions, and regulatory uncertainty, creating a hostile environment for innovation and growth. One of the main issues that the SEC has with crypto is whether certain crypto assets are securities or not. Securities are investments that represent a stake in a company or a project, and they are subject to strict rules and regulations. The SEC has taken the position that almost every Ethereum-based token sold in an ICO, or initial coin offering, is an unregistered security, and the Commission is currently entangled in a $1.3 billion lawsuit against crypto payments firm Ripple over its own sale of XRP. The SEC has also charged several other crypto platforms and companies for offering unregistered securities to retail investors, such as Coinbase, Kraken, Nexo, Terraform Labs, Genesis Global Capital and Gemini Trust Company. These companies have been accused of failing to register their crypto lending products, stablecoins, governance tokens, and other crypto assets that promise returns or profits to investors. The SEC has also targeted individuals who promote or endorse crypto assets without disclosing their compensation or conflicts of interest, such as former NBA player Paul Pierce. The SEC's aggressive stance has created a lot of uncertainty and confusion in the crypto industry, as many crypto assets do not fit neatly into the existing securities framework. The SEC has not provided clear guidance or rules on how to classify or regulate crypto assets, leaving many crypto companies and investors in the dark about their legal status and obligations. Some crypto companies have decided to leave the US market or relocate to more crypto-friendly jurisdictions, such as Singapore, Switzerland, or Malta. The crypto industry has been pushing back against the SEC's actions, arguing that they stifle innovation and competition in a nascent and rapidly evolving sector. Some crypto companies have filed lawsuits against the SEC, challenging its authority and jurisdiction over crypto assets. Some industry groups and advocates have also intervened in support of crypto companies, such as the U.S. Chamber of Commerce, Paradigm, and Coin Center. They have depicted the SEC as a crypto bully that is overreaching its mandate and harming the public interest. The outcome of these legal battles will have significant implications for the future of crypto in the US and beyond. The SEC's crackdown on the industry could either force crypto companies to comply with existing securities laws or drive them away from the US market. Alternatively, the SEC's actions could also prompt Congress or courts to intervene and create new laws or precedents that recognize and accommodate crypto assets as a distinct asset class. Either way, the stakes are high for both sides of this conflict. Stablecoins are digital tokens that claim to maintain a stable value by being backed by fiat currencies or other assets. They are widely used in the crypto industry as a way to trade and store value without converting to and from real money. However, the U.S. Securities and Exchange Commission, SEC, has recently warned that some stablecoins may be considered securities and subject to its regulation. Why does the SEC think that stablecoins are like poker chips at the Wild West crypto casino? And what are the risks that stablecoins pose to investors and the financial system? One reason is that stablecoins are not transparent about their reserves and how they maintain their peg to the dollar or other assets. Some stablecoins, such as Tether and USD Coin, have admitted that they do not hold 100% of their reserves in cash or cash equivalents, but also in commercial paper, corporate bonds, precious metals, and even other cryptocurrencies. This means that if there is a sudden surge in demand for redemption, they may not have enough liquidity to meet their obligations and keep their value stable. Another reason is that stablecoins are not subject to any meaningful oversight or regulation. Unlike banks or money market funds, they do not have to comply with capital requirements, reserve ratios, consumer protection laws, anti-money laundering rules, or audits. They operate outside the traditional financial system and rely on trust and reputation. This exposes them to operational risks, such as hacking, fraud, mismanagement, or bankruptcy. A third reason is that stablecoins are used for various activities that may pose systemic risks to the financial system. For example, stablecoins are used to facilitate leverage trading, margin lending, decentralized finance, DeFi, and cross-border payments. These activities may create excessive leverage, maturity mismatch, contagion effects, and regulatory arbitrage. If there is a shock or a crisis in the crypto market, it could spill over to the broader financial system through stablecoins. The SEC has already taken action against some stablecoin issuers and platforms. It has reportedly threatened to sue Paxos, the blockchain provider that runs Binance USD, BUSD, the third largest stablecoin with about $16 billion in circulation. It has also ordered Paxos to stop minting BUSD. The SEC believes that BUSD is a security because it offers certain incentives to Binance customers to hold the token. The SEC is not alone in its concern about stablecoins. The U.S. Treasury Department has issued a report recommending that Congress enact legislation to regulate stablecoins as systemically important payment systems. It also suggested that the Financial Stability Oversight Council, FSOC, a body of U.S. regulators created after the 2008 financial crisis, could designate some stablecoin activities as a systemic risk and subject them to stricter oversight. Stablecoins are not going away anytime soon. They have grown rapidly in popularity and utility in the crypto space and beyond. However, they also pose significant challenges and risks to investors and the financial system. The SEC and other regulators are trying to catch up with this fast-moving innovation and ensure that it does not undermine the stability and integrity of the financial system.